Hey, thanks for tuning in. In this video, we're going to discuss how to identify supply and demand using the Twitter chart. First thing I want to go over is, we're looking at the daily chart, but whenever you want to find like major pivots, you have to look at the monthly and weekly charts, quarterly even. And the longer the history, the more information you'll get. So, looking at the daily chart, right, I've written down here the 6 or so different things that I use every single day to identify potential supply and demand levels, right? Really what we're doing is looking at the action of previous traders to forecast the probability of future traders. Again, there is no real supply and demand until after the fact, until it's confirmed. But yeah, so let's take a look at the charts and we'll go over the topics. So the first one here is moving average. The second one is point of control, which is this orange line. That's taken from volume. Gaps that are left open on the charts, right? Here's a big old gap. Here's a gap. Highs of bearish engulfing or lows of bullish engulfing candles. Fibs using Elliott wave and trend lines. Those are going to be the ways, and I'm going to do it in real time. Just, I've cleared the chart. We'll just go over everything here. And I'll start from this top, right? This is obviously a major pivot. So this is a clear supply and demand level. This is definitely supply. These are trapped longs. You can see it here. There's volume in the chart. So there's definitely supply there. It's also a bearish engulfing. It's the high of the bearish engulfing. Here's another one, right? So this was a supply problem. It was flipped to demand and confirmed demand, right? Twice. Okay, yeah, let's look at some of the moving averages, right? Starting at the top here, you had this massive correction into ultimately the 200 period moving average. But it's not like the 200 will always be demand. In this instance, price had not touched the 200 in almost 10 months. The slope of the 200 is up, and the distance that price had traveled was about 40% in 2.5 months before tagging an upward sloping 200. So in that instance, you certainly would assume it was demand, but again, closed below it on the first touch just to trick everyone. They then started buying the very next day, then went right back below it again. So if you are assuming that was demand and you're below it now 3-4 days, wouldn't you capitulate and give up? Yeah, that's what they want you to do. I mean, what they're doing is accumulating inventory. That inventory is shares of Twitter in this example. And they know that when they came down here to this low and started buying this bullish engulfing candle low, which again, right off the list here is a potential area. When price came back down to that the very next time, that was a strong buy, 49.20. So they started to reveal their card on this day, May 11th, and by they I mean just market makers in general, the aggregate opinion of all market participants. And what was very ominous too is they did this gap down, right? So there was no volume on this day, 429, and then all the volume came after the gap down in these 2 days. And so if you're looking at a weekly chart, for example, it's going to show that, and let's just clear this up so we have a fresh slate. It's going to show that this is a breakdown candle or bearish engulfing candle, and the high of that candle is up here at 68.36. And you see all this volume, right? But if you don't zoom into the daily, you won't know where those market participants were actually trading, right? So it's very deceptive. So you have to really understand, well, where was the majority of that volume, right? And this is where this point of control tool is very valuable. Like let's say you wanted to take it from this low, right? So like this is the POC, the point of control. This is the value here. So there's a wall now at 53.89. And what are they doing? Well, if you go back in time and look at, since the March low, they're building these bases, these, volume bars that are on the right side of the chart here. They show the aggregate volume and the average of where all the traders were trading. And, if you go back to the March low, it was around $29. So what is this showing you? Well, they were accumulating all these shares back here. They accumulated all the inventory, and then they started marking that inventory up. And even if you come back here, you'd say, well, they were doing it here, they were doing it here, they were doing it here. And now the question when you get to the top becomes, well, was this just all distribution? Are they just distributing all this inventory back to retail now, right? They marked it all up May 2020 to February 2021. They accumulated all of it here, November 19 to June 2020, a year of accumulation. Then they marked it up for about 9 months. Question is this all distribution or is this still part of the markup cycle? So if you go to the high and you take the point of control, right, which is the third item on this list, you'll see that value is at $67. So since the high of all the shares traded, you're at value. Price is sitting at value. Now, if you go to the low, right, where all the volume was, it's way down here. Right? So this is just one way to identify potential supply and demand using the volume profile tool, which relies on a volume weighted average price and a POC point of control, which shows you these horizontal bars. So yeah, that's the point of control stuff. The moving average stuff, real simple, right? We already discussed that. The gaps, we see gaps all the time on charts. And really a gap is just anywhere where the open and close are different, right? So even on this day where the high is 46.17 and then the low is 46.18, right? Well, there's a gap there, but the close was 45.93. So there's also a gap there. If you were to zoom into an hourly chart, you'd see a gap. Same scenario here, right? Close it near low on day, gap up above the 20, which is, they love to do this, right? Oh, the 20 is supply. Look at this big wick. Well, really, this is just market symmetry, right? This big wick was this bearish engulfing candle here, but you stayed above the low. The 48.02 held that low and ultimately captured the 20 the very next day and never retested it until you broke it in March, which really was a blow off top. Like this is certainly wave 3 blow off top-esque. But these gaps that are left open, it's the only reason I'm down here talking about this, are all still kind of unfilled, right? So we came in off this correction, which you could argue is some type of WXY correction. I'm not really here to talk about Elliott wave. I'm just here to talk about how to identify supply and demand. When you got this correction into this gap, we only filled one gap. And what I like to do is come in and take a look at, all three of these gaps as really a demand zone. And if price falls into this zone, I am willing to accumulate shares. Again, you could have just said, look, if she falls into the 200, we're buyers. We haven't touched the 200 in a year. We're a buy. For a long-term swing, it definitely makes sense. That being the case, these gaps come into play all the time, right? We had a gap fill here and then didn't do anything, right? Well, we were supposed to have supply here. What happened to the supply? Well, the supply came down here, right? I pointed this out. This is where all the supply was. So this was that cup and handle look, or your wave 2, your first wave 2 of a larger wave 1. That's where they found the supply, right? They carved up the space down here, and they were accumulating the whole time. right? It's almost perfect market symmetry. But, the gaps are potential supply and demand, right? Here, this gap window was definitely supply. I mean, price went at it and down for 5-7 days. This gap window and gap fill provided no supply, zero supply. And you say, well, why is that? Well, I could argue that's because the PPO was bullish and a bullish momentum above the zero line, above all the moving averages. There's no reason for you to find supply there, right? It also means the probability of supply being up here is much lower since the volume came in these 2 days after the gap down. So it's never as simple as, well, that's a gap, so there should be supply there. No, I mean, is there a lot of volume accompanying that gap? Right. Are you in a bull trend? Like, is price just going up every single day? Were they accumulating inventory down here? All of these things come into play. So that's the gaps. We've discussed a little bit of the high and low of bearish and bullish engulfings, right? So, and even open and close, right? Like, which we've been doing here. Like, the close of this day was 65.09. Well, that's a level of interest for me. The low of this day, right before the gap down, 63.98. That was a level of interest. The high of this candle, right? So the high and lows, very important. Of bullish and bearish engulfings, definitely, but also just of any candle that has a lot of volume in it. And so let's take a look at some of the Elliott wave stuff. And to do that, we're going to go out to the weekly just to get a better idea of what's going on. So it's pretty obvious now that like March 20 was the low, right? So we can assume safely that this little ABC correction that ended led to the impulse move higher that we are currently in. And one way to count this would be something like this. Right? Again, not here to debate the count, not here to talk about Elliott wave, simply here to show you how I use the fibs to find potential areas of supply and demand. So in this particular instance, what we're going to do is take a look at this move, which obviously ended in February of 2021. And in hindsight now, the correction obviously ended May of 2021. But when this top was in, what I was looking for, and again, how you want to count this from some macro level doesn't really matter. What you do find is symmetry and alternation all the time. So like if this is some wave one and this was your wave two, well, this is a really, really steep wave two, right? They retraced 76% of wave one. So if you're going to retrace 76% of wave one, the odds of you retracing 50% or less during wave four are actually very high. That's that rule of alteration. So in this particular instance, this is one way I was using the fib tool. So I took the high and the low. We got a perfect 50% retrace. So let me show you another way I was using the fib tools. So that was the fib retrace tool. And this is the fib extension tool, right? So if this is an ABC, what we want to find is the 618, the 1, and the 1236, and the 1618. Okay. During every zigzag ABC correction, and these rules you can go find out on the interwebs, you're going to find wave C is equal to 618, 1, 1236 of wave AB. And that symmetry in time and price, and I'll go over the time piece here in a second, is what creates this look. So what do you have here? Minus 26%, come up, minus 32%. So very similar, but the math is what creates this symmetry. So price came down to 51.75, and that was the end of it. What's very interesting, and I don't want to get too deep on you, but this is also a bullish engulfing breakup candle low at 51.20, right? So again, a potential demand zone on the monthly chart, a potential ABC zigzag on the weekly chart into a potential demand at SMA, rising SMA 40 after not touching it for 9 months. I've got the breakup candle low, reason to buy. I've got the moving average, reason to buy. I've got the Fibonacci, reasons to buy. I've got the symmetry between wave AB and wave C. All these different things were telling me that this is a confluence of demand, right? And that the probability of getting a rally out of this demand zone is actually pretty good. And not just a rally in this particular instance. When you complete an ABC correction on a weekly chart, even here, ABC down, the expectation is for you to go back and challenge the highs. Now, again, a big bearish engulfing candle on volume that started this massive correction, PPO bearish cross, back to zero line, all that stuff. This little ABC down led to an 11-month rally of 80%. All right. Now, did she set a new high? No, she set a lower high. And to be honest, that could be happening here, right? Here's another breakdown candle or a bearish engulfing. Here's one, right? So that could be happening here. But again, what we're looking for in this particular instance would still just be something like that. Whether it's, if this is an impulse wave coming off of here, best case scenario, right? Everyone loves to see home runs and grand slams. You get something like that. In worst case scenario, which is really back here, you get something like that, right? Which is an ABC up, a 3-wave move up. 1, 2, 3, 4, 5, and then another correction lower. So, again, this is how I'm using the fib tools to identify potential supply and demand. And then the last one on the list here are trend lines. So again, these are not so good. They're very subjective. So the best way to look at them is just connect the highs and the lows. Don't guess, right? Just connect the highs and the lows. Don't try to make it fit into a buy scenario that does not exist, right? So like this doesn't do me any good. There's no value in that trend line. That's gone. So we could do something like that now, right? Maybe she comes all the way back down here into 60 and rallies again. Maybe something like this. Ascending channel, overshoot, something, but again, like it's so subjective, right? It's only really, really good, in my opinion, when you see them break, right? Or you've seen 3 or more tags. So every trend line has to have 3 or more tags because you can connect any 2 points on a chart, right? It's not that complicated. But what you need to see is there to be some type of, that's very interesting. 3 or more touches. That's what you need to see. So again, that's how I use the trend lines. And let's take all this information now and then develop a trade plan with it, right? Like how do we take the potential supply and demand levels that we have and identify profit targets, demand, all of that stuff that's required for a risk reward assessment. So, coming in here, we had a very, very simple setup. When this ABC was in play, what was it here? Something like that. Yeah, 51.75. It became real simple. The closer we got to the 200 in 51.75, the closer we were to risk. So either A, you were a buyer at the 200 where you're going to exit the trade only after weeks of acceptance below the 200, meaning We come down here, we get no rally, we come down to 46, come back up a little bit, the 200 starts to curl down. Okay, that's enough reason to exit. Again, though, what you could do is wait for the buyers to show up, which happened on this day, and then say, you know what? That's my stop. If we close below 49.20, then I'm out. Okay? And you could say, well, you know, where's a good profit target, right? Well, let's take that gap window at 57.63. Let's look at the fib retrace of this entire move, right? The 618's right here. Maybe that's a valid retrace, right? Maybe you want to say, you know what? I'm not exiting until we fill this gap, right? Maybe you say, I'm going to take some off here at this declining simple moving average 40. All of these are just targets, guys. That's all they are. So we've got an invalidation. Let's pull up some targets. 57.63 was one. 63.98. Okay. And then let's do some demand, right? Let's see, where do we think there will be demand? So after this day occurred, we'd say there'd be demand anywhere near 49.20. But again, we could have said, you know what, let's just wait until she gets above this, or let's buy as close as we can to that and then put the stop below. All fine. Well, maybe you didn't get the trade that day. Does that mean you don't trade anymore because your distance was 1% and your potential rewards were 13 and 27%? No, it doesn't mean you don't buy it or not trade it. That's insane. What it means is if it's May 20th and you're buying, you're 6% from risk. So if you're buying this day to sell that day, your risk reward isn't even 2 to 1. So again, buying here at 52, let's just throw it in there, 52.66, right? You waited for the 200 to get captured, then you bought the next day. So this whole time, 52.66 will be your entry, and your distance towards invalidation is $3.46, right? So on these entries up here, you're talking 6% risk, okay? Now your potential reward, 19%, or 3 to 1, all right? So these are the ways that you can look at identifying potential supply and demand, and then developing a risk to reward ratio that is greater than 2 to 1, okay? If we're greater than 2 to 1, we can make money over time. It can't be 1 to 1, can't be negative, has to be greater than 2 to 1, and ideally 3 to 1, 4 to 1. And when you find those setups, right? Like, so even down here, this whole time you were down here, they were accumulating inventory. That even at the worst time, this day here, you had greater than 1 to 1. Right. But again, if this is going to all-time highs, you had 4 to 1. And if this was going to all-time highs, anytime you were at the 200, again, the all-time high is right here. That's it. $80, right? So when you were at the 200, if the assumption was, well, we had a corrective pattern that completed, it was a wave 4, impulse waves are 5-wave moves, we should have one more move higher, right? Or a weekly SMA 40, the slope is up, it's trending up. Whatever your assumption is for that higher prices are coming, while you were at the 200, your risk reward 5% lower for 50% gains, 10 to 1. Now you don't know it's going there, okay? You take profit along the way. But again, you have to understand, developing the risk reward is part of the plan. And if you understand that, yeah, it may not work out, all of these trades will not work. There will be trades that don't work. But if we are buying this same setup of, weekly ABC correction, wave 2 low, wave 4 low, a wave C low. If we're buying that over and over and over again, if we have good money management and we're taking these like 4-to-1, 10-to-1, 3-to-1 risk to reward ratios, we will make a lot of money over time. What can't happen is for this to be wrong and you to stay in the trade as she comes down here to fill this gap at $39, right? So again, cut your losers, ride your winners. And this is how I identify supply and demand and use that data to calculate risk reward. If you like the content, please subscribe to the channel, reach out to us on Twitter, and catch us in the next video.